the market appreciates over time. There's also inflation in the market, which is things generally cost more this year than they did last year. So here is the consumer prices from Fed, and that's the amount of inflation tracked that way. Fed just tracks it, and sometimes it's 5 or more%, and more commonly it's at 2 or 3%. Fed has said that they like inflation to be around 2% a year. But this varies by year, and it allows for the value of properties to increase over time. So here's the home sales price for homes throughout the United States. It was obviously much lower back in the 60s, and now it is well over 400,000. And so you can see that market went up and then down in 2008, 9, and 10, had the Great Recession, and then it's been going back up, went flat in the years to 2020, and then spiked in 2020 up. COVID and people and the demand for housing increasing substantially. And now that the interest rates are higher, things have kind of leveled off. Appreciation of over 30 years, you're probably already familiar with it. Basically, if you have a property that is $400,000, you put 25% down, you have 3.5% annual growth, it's going to be worth over $1 million in 30 years. And we have had more than 3.5%. It's been closer to 4.5% annual growth throughout the United States, and see how that has increased in the past. Not all markets are the same. The black line is the same for both. That's the median for the U.S. This is through the National Association of Realtors, and it's taken by quarters. That's why it doesn't look exactly like the other graph. I found the National Association of Realtor numbers here is pretty close. This is the Sacramento market. You can see that it started almost the same at the United States back in 89, went up dramatically in 90, peaked, went down to 97, back up to 2005, went down again. And so some markets are more volatile. You can see on the right-hand side, Akron, Ohio, substantially less volatile than the national market.